All right, good, excuse me, wow. All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. My apologies for that. That's what I get for having been silent for a little bit. We'll get started here in just about, we'll give it about 30 seconds here, and we will get off and rolling. All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I know for many of you, market's been going here for 7.5 hours, ready to call it a day. So I appreciate you tuning in, and hopefully can give you some stuff that's going to help you going forward and navigate some of the waters that are out there in this market right now. Today that's what we're going to talk about. We're going to talk about some of the volatility, some of the way the market has kind of acted. I'm going to make an argument that the market's actually acting very normal for a change, which just simply means we kind of have a little bit of a better roadmap. And we'll kind of cap it off by looking at some of the specific stocks that are going to benefit the most in this type of environment and going forward over the next several months. I have a chart of the SPY up here, and if you've been watching the market, first thing you're going to say is, "Wait, Jeff, you're missing a few days." Yeah, I've gone back in time a little bit. Right, going back in time, because what happened is we saw the market pull back on this day right here, and we saw the market metrics turn bearish. We saw a lot of things like the bullish percent index break down. We saw things like the number of stocks making new highs, new lows break down. We just saw the market internals really turn bearish, and the market pulled back a little bit, and then it had this kind of just sell everything. Sell everything day. Who cares what it is? Just sell it. We haven't had many of these days over the last few years. We did have one, kind of 3 earlier this year. A few smaller ones a little bit later in March and April. But, this has not been a characteristic of the market really since 2013 to have much of this type of action. So nice little 3% down day, and everything gets thrown out. It doesn't matter what your fundamentals are. It doesn't matter, what your story is for the stock. It's going down. Very few exceptions. And on this day, this is where I jumped on video with the Trader Minute community and talked about the roadmap for what's likely to happen going forward. And basically, what I'm going to do here today is kind of lay that roadmap out. Look at where we are now in terms of that roadmap and what to expect going forward. The first thing we know, when you see an outsized day of this magnitude, you know the sell-off is not over. This is not bottoming action. This is not, something where all of a sudden fund managers are going to wake up the next morning and go, "Oh, I think I want to buy." No, this is where they look and go, "What am I missing? Uh-oh. What's going on? Oh, no. This, that, the other." They find a reason to sell. And we go forward another day, and there's, more sell. And if we tack that next day on, you can see gap down, rally, sell, came off of its lows, but we get this heavy sell. And I'm going to put the volume on this, and I'll just overlay it. We'll still be able to see. But check out the volumes. Check out the volumes. Monster volumes compared to other days, right? Huge volumes that come into the market with this action. This is very normal. In fact, we saw it right back here. And when we see 2 days with volume like this, it tells us, look, there's some importance to this level. There's some importance to what's going on here. And at this point, yes, we could still be in free fall. But you know what could also happen here? One of the biggest bounces in a long time. If you go back and you look historically at the biggest up days in the market, they all happen during bear markets. They don't happen during bull markets. they're all there in 2009 and 2008, where you get the market rallying 5, 6, 7%. That doesn't happen in a bull market. That happens in bear markets where you get really heavy volatility. And so at this point, that's what comes into play. Yeah, there's flush risk, but you know what? There's also some pretty risky bounce or pretty heavy bounce potential here to it. And we talked about that bounce risk, and, we end up getting the bounce. The bounce comes in fairly soon. If we kind of fast forward this a few days, you can see the next day bounces on up after kind of a pretty wild day. And then we fast forward another few days here. Let's go to the 17th, and you can see, boom, here we go with the bounce. Right? And the next day, market tries to sell off, rallies. Is the market in the clear? No, the market's not in the clear. In fact, these bounces become sellable overall. Now, there is always a question of how far is the bounce going to go, right? And, how much is there going to be and what levels. This happened to be at one of the key retracement levels. And if we look back here, you can kind of see similar, big bounce right here and then reverse on back. But what we know about markets like this is that the lows get retested. And while option prices were insane, earnings upcoming, it was kind of an insane environment from an option standpoint. The chance of the lows being at least retested, if not taken out, are extremely high. That would be the norm. What would be the abnormal? Is a V-shaped recovery. That would be very abnormal and would need some sort of really heavy major catalyst. So we fast forward a little bit, and we come into the market today. And we come and we put on today's action. What do we get? We saw the market bleed on, bleed, and then this morning gap on down. Well, lo and behold, look where it gapped down to. It gapped down to these lows from, a week and a half prior. So here we are. Big drop, fear-based. We get that kind of monster kind of rally in the middle. And then that gets wiped on out. At this point, right, yeah, we could go further down. We could, sit at this level a little while. But the chance of bouncing at this level is a little bit more elevated. Not elevated to the point where I want to mortgage the house and go all in on the open, but at the point where I look and I say, you know what? If we start to get some interesting action, maybe there's some stocks out there that become buyable. And the one thing that we continue to preach, and you'll hear me talk about today, is the fact that in the short term, new lows are coming, and we got those today. But in the long term, new highs are coming. New highs to this market are coming. Now, I made that same statement right back here as far as new highs are coming in the market. I don't mean they're coming tomorrow. I don't mean they're coming next week. Heck, they're probably not going to happen before the end of the year. It could. It would need a catalyst. But overall, when the market goes into these fear-based positions, the market's concerned about what? It's concerned about China, right? Some fund manager in China is going to sell. Okay, great. It's concerned about Saudi Arabia and Turkey and all of that scenario. Italian bonds it's worried about. U.S. President Trump's tweets, U.S. politics. The upcoming midterm elections, right? We have a lot of stuff ongoing. We could just go to any kind of market page, and there's a huge, what they call, wall of worry. Lots of things to worry about. And yeah, you can look at all of those, and you can say, well, what's going on in that scenario, and does that mean the market's going to go up or down? And you could kind of just scratch your head and go crazy, because the bottom line, by the time that scenario is resolved, the market will have moved past it. But what drives the market over time? What is the real driver of the market? If I back this market out and we come and we look at something like a monthly here of the S&P, and we just look over time, what really, truly drives the market? Is it Brexit? Is it Russia and Ukraine? Is it Ebola? I mean, we've had all those issues go on. All of those issues are waves. They're ripples. What drives the market are earnings. Earnings which can be driven by the economics. And so we'll talk about earnings and economic data kind of hand in hand here because they both matter. What drives big pullbacks? What happens to corporate earnings during these pullbacks? They pull back dramatically. Revenues drop, earnings drop. Yes, it's blamed on housing and all of that, and that kind of fueled into some of the revenue and earnings drop. But if revenue and earnings were going up while the housing crisis happened, housing stocks would have gotten sold and the rest of the stocks would have gone up. What has fueled this rally in the market that some say is unbelievable because valuations are stretched and insane? Well, why do people keep buying stocks that many say are overvalued? Because they continue to have earnings growth and they continue to have revenue growth. Corporate profits continue to rise. And so the question on a pullback like this, it's not necessarily, hey, what's going on with China and U.S. trade relations and what's going on with Saudi Arabia and Turkey and the lira and what's happening in Italy. The question is, look, I know there are things out there to create panic. And the market's human. It panics. But is something fundamentally changing that I need to look at and say, hey, this change is happening. So you know what? We could see a really different market going forward. Or, look, this is just a shakedown. Yes, fear, and this is normal. It happens. But ultimately, I need to be a buyer. To see it, we need to look at the economics and we need to look at the earnings. I'm going to show you two things here. One, there's a website, FactSet. And if you Google search FactSet Earnings Insight and you come into it, it's going to give you an earnings scorecard. And we're in the middle of earnings season right now. And so on Friday, every Friday, they update this. And it's really good. Really good information, right? But you can come in here and say, hey, the blended earnings growth rate for the S&P 500 is 19.5%. If that is the actual rate for the quarter, because there's only 17% of the companies that have reported, it's a big enough sample size, though, to say, hey, it's going to be pretty good. It will mark the third highest earnings growth since Q1 of 2011. Monster earnings growth this season. What drives markets? Earnings growth. Okay. Huh. All right. Then why isn't the market going up? I mean, why does a company like Bank of America report such great earnings and it gets sold off? What's going on? Is this just fear? Is there something else going on here? Well, we can come in and we can look at all the compiling of numbers, but I want to boil it down here to what essentially is going on. While we have all of these companies essentially beating on earnings, their earnings surprise percentage is below the average. So yes, 80% of companies out there are beating on earnings estimates, but they're not beating by as much as they have been. And then when we go and we look at the forecasts, what's happening is we're looking at, this kind of monster growth rate in earnings, that 19.5% earnings growth here. 7.4% revenue growth. Those are really good numbers. But the expected growth going into 2019 is essentially cut in half. It's cut down to 10%. And so what's going on? Well, we have really good numbers. We have really good earnings. They've been bought up, and rightfully so. But some of the expectations going forward, there's a lot of nervousness in those expectations. What does that tell us? That tells us that the chance of a V-shaped recovery here, it's not going to happen. It's going to need a catalyst. All of a sudden, we would need to see analysts raising their estimates like crazy for 2019. They need to have some sort of catalyst for that. Change in the tax rate. All of a sudden, China and the U.S. making nice and dropping all tariffs. Right? There would need to be something to that degree for that to happen. Because while, yes, 10% is still a pretty darn good growth rate, it's slower than what it has been. And what does the market do when it starts to grow slower than what it has been? It does what it did here in 2014, 2015. It just kind of slows its upward movement. It gives a pullback and a rally back and finds a little consolidation zone until it can see that earnings going forward are actually going to see an increase in growth. Not that they're going to grow, but they're going to increase in how much they grow. A second derivative there. And so right now, we're kind of in this kind of period here, 2014, where market's looking and saying, yeah, it's been great, grand, and wonderful. And yes, the data is fantastic, but we're a little worried about the little bit of slowing in that, and so we may need to consolidate some of these gains. Does that mean big market pullback? No, it absolutely doesn't. But it does mean, hey, it needs to find some sort of range. Now, ultimately, what drives corporate profits, corporate earnings? It's the economic data. Throughout this rally in the market over the last 10 years, there have been times where the economic data has turned, has gone south, and we've seen, some sizable corrections like 2011, even 2010. I mean, we saw some in 2012. But overall, we've had a little bit of economic weakness here in 2015, but overall the economics have been improving at a pretty fantastic rate. And one of the things that I want to see when the market's pulling on back, is it pulling on back because the economics are deteriorating? Or is it pulling on back because the market's afraid that the economics will deteriorate? Because the market becomes afraid of deteriorating economics all the time. But it only truly prices it in and really sells off on it when the economics are deteriorating. So let's go take a look. There's a website called Trading Economics. Really easy. If you're a data nerd like myself, you kind of love it. But I'm just going to kind of be brief with it. But let's just go take a look at U.S. data. Right? Let's go take a look at what it looks like. GDP growth rate, 4.2%. Is that good? Well, let's click it. We can click on that, and it should bring us up a chart. Looks like it's it's got a little repeat in it. Let's see if we can't get rid of that. It looks like Trading Economics wants to go down. Let's see here. Let's just go click on something else. This is an interesting time for it to go down. Let's come into something a little bit different here. Let's see if we can get down here. Let's come into the consumer, right? One of the big arguments out there is, the consumer, which makes up a big part of the economy, 2/3 of it, they're going to be strapped because interest rates are rising. Well, let's take a look at consumer spending. And yeah, my apologies, it's not coming up. But bottom line, consumer spending, all-time highs. You say, well, is that just because of debt? No, because the personal income is rising at a record rate. Households' debt to GDP has actually been on the decline in a big way. Very positive economics, and those trends, I can't show them to you here. If you want to go check it out on your own when the site comes back up, all you have to do is click on them and go to the 10-year chart, and you can see the overall flow. But those economics are very positive. We can come in and we can look at imports and exports, right? There's a lot of angst and worry about imports and exports right now with China and the U.S. and trade war and all of that banter, right? But what's really going on? Well, exports and imports are still growing. Exports have come down a little bit, fractionally, in the last 2 months. But overall, they're still growing. But maybe the most important piece of data, and we can go into most of this data, and as long as we stay away from housing, it's growing. The reality is housing is shrinking, and it's a pretty good correction. It's nowhere near record levels correcting off of, but that's the only area where the economics are turned. And they've been turned for a while. But perhaps the most important piece of economic data lies here in business and down here in new orders. And this comes down to manufacturing orders. And when we see new orders on the rise, that is one of the more one of the pieces of economic data that will forecast what the economics are going to do going forward. And it's been fantastic for many, many years. And the one thing we see month over month over month is new orders continue to rise, not just in the U.S., but around the world. Yeah, we see a little more volatility in China than elsewhere, a little more volatility in India than elsewhere. But when you're talking about the U.S., Europe, some of the bigger economic centers of the world, even Japan, new orders continue to rise. And so one thing I have to ask myself is say, okay, Jeff, yeah, we're pulling back and there's all these worries. And what do the economics and what do the earnings basically tell me? Well, they tell me this. They tell me the economics are just fine. They tell me the economics are not only just fine, but are actually going to continue to increase. When the economics increase, we tend to see the market go to new highs. Based on the economics, we will see the market go to new highs. When? Is that going to happen tomorrow? Is that going to happen next week? Well, no. When we look at the earnings are great, but as we talked, the earnings estimates going forward are lower than what the growth rates are right now. Still growing, but not as quick of a pace. So what's that tell me? It's going to take a while for the market to hit new highs. Maybe March, April, May of next year. So what does that mean? For a trader, what does that mean? Well, that means we're probably going to have an environment that is very similar to what the environment has been most of this year. We are going to have nice upticks and we're going to have strong downticks. We are going to have more movement overall, and this return to the market just moved 3 points. I wonder what happened is gone. We're going to have bigger movement overall. So how do you trade it? What do you trade? What do you get involved with? Well, take a look at the market here. The market hit a new high back in January and then hit a high again here in August, right? You say, well, okay, great. What does that have to do with anything? Well, let's take a look at a few stocks. Let's take a look at Amazon. Notice what Amazon did. Amazon hit a new high, here ahead of the correction, the market correction, January, February. And then 3 weeks later, it hit a new high again. 3 weeks later. So as the market is going forward and hitting new highs, what stock is leading the way? Amazon. Is it immune to pullback? No, it's not immune to pullback, and it's not something, it goes, hits a new high and, go buy. But does it outperform? In a huge way. What other stocks did this? Take a look at Apple. Here's Apple in January, February, pulls on back. Takes a little bit longer to hit a new high, but hits a new high. Does that mean you go out and buy Apple right then and there? No. But as time goes by and as the market pushes into new highs, who's one of the big leaders? Yeah, Apple. What about Adobe? Goes back. Here we are, January, February, hits new high very soon. One of the best outperformers. So you look at this market today, and you say, well, who do you buy, who do you sell? Well, right now, there are very few stocks hitting new highs. And you know what? When the market rebounds, there's not going to be a lot of stocks hitting new highs. But those stocks that hit new highs in the coming 2 to 3 weeks, Think about what's going on. For a stock to hit a new high in the next 2 to 3 weeks with everything that's going on, they've got to be doing a lot that's right. And those are going to be the stocks that get rewarded the most going forward. And so as we go forward over the next 2 months, one of the things that you can easily do, you can go into any new site or any site out there and simply go to the number of stocks hitting new highs on that day. Here on stock charts, we can come down here to predefined scans, and we can click on new 52-week highs. Now, I don't really care about some of the, the ETFs and all of that. I'm looking for just some of the bigger names in the market. I mean, Disney. Seriously? Disney set a new high today? With everything that's going on out there? Wow. Something's going right. Something's happening. What's that mean for Disney going forward, right? And this list is a day old, so Disney actually hit a new high yesterday. But there we are with that list, and we could come into this list each and every day over the next 2 months. And the stocks that hit new highs, these are going to be the ones that you're going to want on your watch list that you're going to want to buy on any kind of dip that will come in, because they're still going to be prone to dips, right? I mean, Disney's still going to go down, from time to time. But when you talk about a stock when it pulls back that has a better chance of pushing on higher, you're looking at Disney. You're looking at Disney. And we're going to have a lot of those stocks over the next 2 to 3 months that are going to show those colors before the market itself actually hits a new high. And then we'll see the market hit a new high. There'll be more stocks, but it won't be as readable to what are the best stocks out there. Now, while that's going to set some things up for the next while, what does that mean about, here and now? Well, today I did a couple things. In fact, this morning I got on video and I mentioned that I bought some lows. I bought shares, half position shares, down here at the 200-day moving average. Stepped in and said, you know what? I'm going to use this opportunity to step into a few names that I like, that I liked when they hit new highs, and now that the market's given it a discount, I still like. Now, I wasn't gutsy enough to go with options in it and, think, oh, I'm going to buy a weekly and it's just going to bounce real big. No, I mean, this is something where I want plenty of time for it to play out, and I bought a half position so that if the market forces a further dip, I can buy. But I wanted to buy this on the activist investor action right back here in August. I never did. I was waiting as it went up, waiting for a pullback. As it started to pull back, and never got a real good buy signal to come in. Now we're back to the 200-day moving average. All right, I'll take advantage and go buy some. But there are 5 stocks out there that I think, based on the earnings that we have seen so far this earnings season and this market environment, will easily make new highs before the actual market sets new highs. One of them is Nike. Now, Nike may be the hardest one to justify fundamentally because it is trading at a very premium PE ratio, up around 22. It's a little more expensive than some of the other stocks that are out there. But Nike has gone through a transition year, a major transition year, and has kind of transformed the company a bit. We've now had a dip here on some of the China issues and those concerns, the market issues and those concerns. But when you look at the numbers in Nike and what's going on, they're still in that early part of transformation. And so this is a stock that I expect to kind of come down here to the 200-day moving average, finally find a little support, maybe break it a little bit, but ultimately be one of the leaders as the market goes on back. This one's probably the hardest to justify fundamentally, but I think the story there is strong enough to expect that. The second one, and maybe the easiest to justify fundamentally, is Adobe. There's a stock where the market set a new low today and Adobe didn't. Now, that doesn't mean it's immune to setting a new low, but we saw the earnings on Adobe a few weeks ago. Fantastic numbers. And the market starts to go down and takes Adobe on down, right? But overall, it finally created a little correction here for Adobe. This is one where you can easily look at the fundamentals, value this at 320, 340, even 360 if you want to stretch it. But a stock that has a good chance of setting a new high before the market, Adobe is one of the tops on my list. In fact, I picked up some call options on Adobe here today, just kind of playing some of the risk reward on it and saying, okay, you know what, if the market does have further bounce in it into the rest of the week, can I play Adobe up to 267, 268, here in the short term. So I grabbed some, with a little bit of risk on them, but plenty of reward potential. Next is CSX. This one I'm not as eager to go grab right now. But when we look at stocks that have a good potential of turning around, you go look at CSX's earnings. They were great. I mean, why is CSX pulling back? Because of the transport sector. It's absolutely because of the transport sector. And this is one that when some reason, when some logic, when some calm comes back into the market, they're going to buy this up to 80. And it'll probably be one of the first stocks that sets a new high when we see, some snapback really coming back into the market. Number 4 is JP Morgan. These banks have been pretty incredible. JP Morgan just set a new high not too long ago, last month. I mean, it set a new high. And then we get the Fed. And the Fed does something. They raise rates, and they talk about raising rates going forward. And what does it do? It actually takes the yield curve and steepens the yield curve. Well, what's so big about that? Well, a steeper yield curve means more profits for the banks. Also, why did the banks pull back right here? Because the market was worried about a contracting yield curve. So, market gets a steepening yield curve and decides to sell the banks on that. Logical? Rational? No. And as you go and look at the news on the banks, you look at the earnings, you look and go, whoa, these are fantastic numbers. And then you start reading the reasons why banks are going down and all the reasons that are being made up for the banks to go down. And you go, wow, these are pretty flimsy. These are some pretty interesting made-up reasons trying to justify it. But the bottom line is panic selling, fund managers needing to get out, to take their lumps and move on. Here's a weekly chart of JP Morgan. It's been in a multi-year consolidation. But when there's some reason and logic that comes back into the market, these banks, investors are going to look at them and go, wow, steepening yield curve, great jobs. The Fed, yeah, they're going to do what they do, but it's not going to affect things all that much. And then the consumer is incredibly healthy. What are we doing? Selling banks. Now we're going to see these banks take another really kind of monster leg to the upside. Now, in the short term, there's still a little more downside risk. Yeah, maybe. But as far as JP Morgan, Bank of America, chances of hitting new highs before the S&P hit a new high, they're top on my list. Oh yeah, fundamental valuation justification. I know JP Morgan's up a lot in the last couple years, but man, it's still one of the cheapest stocks on the Dow. Last but not least, and they just reported Honeywell. Now, this is one that I debated putting on this list. This is one of those that has come back down to the 200-day moving average, some big volume, right, and probably bounces off of this level. I'm not as convinced that Honeywell sets a new high before the market itself as I am the other stocks. But I do think Honeywell is a very interesting gauge. Honeywell will rally. And if Honeywell does break into a new high, we are going to be talking about a market that goes to another level. Where, the S&P is trading where it is now, it'll be trading 20 to 30% higher in a year and a half. If Honeywell hits a new high with everything that's going on, that's what it'll say about the market. It'll say the overall market has a long way to go to the upside. But to expect Honeywell to at least come back and retest these highs, I think is very reasonable as the market kind of rebounds and as the market kind of moves back higher. I'd be surprised if we don't see some money rotate into Honeywell from things like Triple M. And in fact, I would not be surprised if we don't see some money rotate from Triple M into UTX as well. In fact, you could probably say UTX has a better chance based on the earnings of going and hitting a new high than Honeywell. But I put Honeywell on this list because I think it says something massive about the overall market if it does set a new high before the S&P. And if you look at it fundamentally, I think there's a very good chance that that happens. Now, many of you within the sound of my voice right now are option traders, and you're looking and say, well, when do I buy options? Well, think about where option pricing is right now. Option prices are expensive. The VIX is high, right? A lot of these companies have earnings upcoming. I mean, Apple has earnings upcoming. Amazon has earnings upcoming. The options are kind of insane. Interesting way to kind of play some of these to the upside. Let's take Nike, for example, is to come in and trade it a little bit differently. Come in and take something like a Nike and go out to December or January of next year and come in and take a look at some of the call spreads. You can buy a call spread here on Nike for about $1.50 for the 75/80s. It's a little expensive for my taste, but you can offset a lot of the implied volatility. You can offset a lot of the time decay and take advantage of a bigger move. Can Nike get up to over 80? Well, yeah, that wouldn't even be, that'd be just a retracement of this move. So we're talking about things that, spreads that you can buy. You can offset the implied volatility. You can offset the time decay. If you're not familiar with spreads, check out the video library on Trader Minute. Plenty of stuff talking about those different spreads. But I think that's one of the best ways to add upside exposure in the market today. Because you know what, if the market does decide to take another leg lower, if it does decide to have a little more turmoil, you can sell the leg that you bought, or excuse me, you can sell the leg that you that you bought there and hold the other one and play for a rebound. But there will be strong buy opportunities for just normal call option players. When do the best opportunities come? They tend to come after the lower low is in and you get a higher low. So let's just say Nike sells off for another 3 days and then snaps on back to 75. Right? Let's just theoretically say that's what happens. Well, when the option trader set in, what's the chance of you picking that low? And even if you do pick that low, what happens to your option as the stock goes up? Yeah, the implied volatility comes out. And so you're really not making all that much unless it's just a monster bounce and you're deep in the money. But the best time to generally buy is after that next pullback that sets a higher low. When that higher low is set, not only do you have a better risk-reward scenario, but you have a cheaper option. And when it starts to go up off a higher low, you think the algorithms are watching? You think the fund managers are watching? You think the traders are watching? Do you think they're looking at it and saying, oh, okay, here we go. It's ready to go. All aboard. And so while I know there's a temptation to want to pick bottoms and pick bottoms and pick bottoms, that's kind of our natural human psychology. The best time to play the options is generally on that first higher low. And for many stocks like a Nike, that's still going to take another week or two to play out. That's still going to take some time. That's not going to happen here tomorrow or anything like that. But when it does happen, load the boat, let's go. And, call option players are going to make some very good money. Now, I mentioned, for the challenge, 100K challenge that we do at Trader Minute, I bought some Adobe here today and whatnot. If you want to see all the trades for the 100K challenge during this period, where we live trade through this time period and through these signals and setups and talk about them on a day-to-day basis, come check us out on Trader Minute. There should be a sign-up link kind of near this video, and you can check that out. Check us out for free for a little while as well. And if you have any questions, feel free to shoot them over to us. But more than anything, I wish you great success in your trading going forward, a strong end to 2018, and the market environment is definitely one that's going to be more conducive for traders going forward than what it has been for a long time. Have yourselves a great evening. Thanks for being with us, and we'll talk to you later. Take care.